Welcome back to another video. My name is Jorin. I'm a quality investor and a writer about quality stocks on Substack. Today, we're not going to be reviewing any earnings. We're not going to be reviewing any company in depth, even though Meta, Apple, and Amazon released stellar earnings. We're not going to review them. You've probably already seen them. Today, we're going to be doing something different. I'm an avid user of TikTok. I like to scroll on it when I'm on the toilet or when I'm just not in the mood to do anything. I just scroll TikTok. Usually it's funny videos, usually it's sketches and all that stuff. But from time to time, I come across this financial TikTok and where I think, just don't post it. Or I actually think more people need to see this. And today I want to take you on a journey on the TikToks that I get promoted on my For You page. I'm going to give my honest opinion and I'm really curious to hear yours as well. So along the way, write down your thoughts in the comments and post the thoughts once the video is done, because I really want to know your take on these videos. So with that being said, we're going to dive into the first TikTok. So the first TikTok is a money expert that explains to us why the S&P isn't worth your time. I'm very curious what he has to say. So let's just start the video.
S&P 500, that grows at about 10% a year, 11% a year. So let's imagine you've got your $1,000. Well, 11% a year is going to take you a fucking long time to make any money, right? So it is not worth your time. Okay, then we go to technology stocks. NASDAQ does about 18% a year. Okay, that's starting to add up because these numbers compound after a while. You know, it goes from 1,000 to 1,200, and then, it's another 20% on top of that, 20%. These numbers add up fast. Bitcoin, since 2011, been 145% a year, even with it falling 80% 3 times in the middle of that. So 145% a year, as long as you're in it long enough, okay, now that's really starting to pay off. And then as you get slightly more speculative, i.e. take a bit more risk in things, well, the returns go up, but they become riskier. So once you start moving into that world, okay, this is a whole different world now. Now the guy with $1,000 can get rich.
There's a lot to take in here. I think it's a good TikTok. It probably resonates with a lot of people. It just doesn't resonate with me that much, and there's a good reason for it. I have a feeling he underestimates the true power of compounding. So I've done some calculations. Let's say your initial investment is $1,000. Your monthly contributions is going to be roughly $300. With an annualized return of 10%. And we're going to take a time period of 20 years. You would have totally invested yourself $73,000. That's the money you've earned that you've put into your brokerage account and bought an index. The value of your portfolio after those 20 years at a 10% return with a $300 contribution every month, so you do have to contribute a little bit, the total portfolio value would be roughly $235,000. The discrepancy between what you've invested, so the $73,000 and the $235,000 of the total portfolio value, the difference between that, $162,000, that is the power of compounding. That is your annualized returns. You had to invest $73,000 yourself. You just bought the index with an annualized return and you had to contribute monthly to the portfolio. And with actually doing nothing, you've gained $162,000. Compounding is the eighth world wonder. It truly is. Compounding is what helps you to generate real and sustainable wealth. So another thing I have some trouble with here, equities like the S&P 500, they represent real ownership of the business. So if you buy an index, you buy small parts of actual ownership in the business. So each share is a claim on a company's earnings, assets, and dividends. So companies like Apple, Microsoft, Johnson & Johnson, they generate real cash flow and reinvest those cash flows for growth and innovation, and in return, you get shareholder value. They buy back their own shares. That means there's less shares outstanding. That means there's more earnings per share, and there's more free cash flow per share, and that drives up the share price itself. Moreover, there's a proven track record with the S&P. The S&P has returned around 10% annually over the past century. Bitcoin hasn't been around for that long as the S&P has been. The S&P has weathered wars, recession, inflation, crashes, and yet over time, it still sustainably and predictably grows wealth. Another part is intrinsic value and reinvestment, okay? Stocks, they generate their earnings and they generate their cash flows, and these can be measured and valued. Bitcoin doesn't have an underlying asset that can be valued. Bitcoin doesn't have underlying cash flows that can be valued. Moreover, these companies, they pay dividends, and like I said previously, they buy back shares, and that enhances the investors' returns even in downturns. So let's say we're in a recession, the share price is falling, but the company continues to buy back its shares. That means there's less shares outstanding, that means the pie is getting smaller, and that means the shares you own actually represent more of that pie. So you're getting more for your shares. In the long term, as soon as the recession is over again, the share price will appreciate again, and you will reap the benefits from this. Another thing is diversification. So if you buy Bitcoin, you're not diversified. You only have Bitcoin. If you buy the S&P index, the S&P index includes 500 of the largest US stocks companies across all sectors. This also evolves over time. So there's companies that are going to be lagging behind. There's going to be companies that, due to this lagging behind, fall out of the index. And the ones thriving are the ones that are going to rise in this index. So they're going to generate more returns for you. This creates a dynamic and self-improving portfolio, something you don't have to do anything for. So you just buy, you just hold, you contribute to it monthly. And the index itself evolves. The index makes itself optimal. The index is going to make sure you get your returns. Bitcoin, it lags in very many aspects. And as he said, you're taking a lot of risk and you get a lot of return. Yeah, you do. But that is because you take a lot of risk. I do not want to take risk. If I invest $1 million right now into the index, I'm comfortable just if the world just stops working, I'm comfortable if I cannot see on my broker account to see what the price is doing. Because I'm sure that in the next 10 to 20 years, share price will appreciate. The underlying business will start to appreciate. They'll start to have more earnings. They'll have less shares outstanding. They'll have more free cash flow. They'll be reinvesting back into the business. And adding to that, if they have a high return on invested capital and return on capital employed, I'm sure that they're going to generate a lot of sustainable and predictable earnings. Bitcoin, it lacks this, so I'm not a fan of Bitcoin. And again, if I'm going to invest $1 million into something, I do not want to see it just depreciate by 80% 1 month, and then 100% the second month, and then minus 60 the other month, and then minus whatever the next month. I just want to see sustainable and predictable growth. So yes, you cannot avoid having a bear market. You cannot avoid share depreciation at all. That's almost impossible for us to do. But I want something sustainable and predictable, and that has proven that over the long term generates wealth in a sustainable and predictable way. So a key thing you might hear, sustainability and predictability. That's what it's all about. So yes, he is right. You can get a lot of returns with Bitcoin, but I do think the better option for most of us regular schmucks like me and you, we're just better off with the S&P, with the index, or with a couple of high quality companies like the Mag 7, except Tesla, to just own those, hold those, contribute monthly, and just let compounding do the rest of the work. That are just my thoughts, my opinions on this whole situation. I'm curious to hear yours. So write along, as I mentioned previously, and drop a comment after the video is done. So with that said, we are going to watch the
best investment in the world today. I'm not kidding you. Better than real estate, better than oil, better than gas, is silver. Because this is going down.
I hear you.
When this goes down, the rupee goes down with it.
Okay. All right.
So if you want to get rich, get silver today. Best investment of all. This is $35 US.
Yeah, no, no, do not go into these metals, precious metals, whatever floats your boat. They're equities. It's the best option you have. Holding dollars or euros, that's almost one of the stupidest ideas someone could ever come up with. Don't invest in currencies. Don't hold currencies. Do put them in some type of or invest them in some type of way. But do not go with gold or silver as well. Those do well in times when there is global uncertainty because people flee from the equities to the metals. But those are very short times in the overall market where this happens. So if you would have bought gold, let's say in 1950, I have a chart here in front of me. So from 1950 till today, okay? The S&P has returned, according to this graph that I have here in front of me, hold your horses, 33,345.06%. The Dow Jones has returned 20,880.30%. Gold has returned 9,247.33%. Silver has returned 4,259.55%. Gold and silver have always underperformed over the long-term equities. They've always done so. So I agree with him that you can better invest your money in other assets. If you had to choose between gold, silver, and holding the dollar, I would definitely go with either gold or silver, whatever floats your boat. If you have the option to go with the S&P 500, the NASDAQ, the Dow Jones, gold, silver, or the dollar, look into the Dow Jones, look into the S&P, and look into the NASDAQ. Those are proven, and I'll put another graph on screen right now. Those are proven to have outperformed those metals over almost every period of time we have endured. So, is it good advice? No, there's way better options out there. Definitely, there's way better options out there. So I would go with the S&P or the Dow Jones or the NASDAQ within a heartbeat. I do not hold any gold or silver for this specific reason. I have a higher return on the investment with equities, so I'll keep investing all my euros because I'm in the Netherlands. All my euros back into equities and especially into high quality companies. So I love this man. I love his book. It's actually the first book I ever read on finance, personal finance. I love the book. I love the story. I love this person as who he is. I think sometimes he has really good tips, but I think this is not a good tip. I do not think this will get you far. It's going to generate returns. Don't get me wrong. It's definitely going to generate you returns, but there's better returns out there. And I think that is in the S&P, the Dow, or the NASDAQ, whatever you pick. I think you'll be better off holding that instead of gold. So we're gonna go over to the next TikTok.
A year ago, I invested $7,000 into a brand new Wealthsimple account. Here's the journey of the money. In my first week, I made $700. And in my first month, I doubled my money. But then for a few months, it went sideways. Until I decided to invest in GameStop. Let me show you the craziest week of my life. In my first day, I made $8,000. I had a tweet that went viral, and I was being quoted on Reddit. And I went to bed that night with $18,000. And the stock doubled overnight. And I woke up to $44,000. But I wasn't ready to sell just yet. And when Robinhood decided to block the people from buying the stock, I lost $15,000 in 15 minutes. And I decided to close my position and return to normal investing. I did really good one day, and then the market crashed. The 3 next months weren't so good. And when the summer came, I made all my losses back. But I am still losing a lot of money with this stock. And the final result is that I tripled my money in just a year.
Okay. I loved where he said, and after this, I returned to normal investing. Yes, because buying GameStop and very speculative shares, as you can see, you can get a lot of returns in a very short amount of time. I think after a month, he had doubled his investment. That's 100% return. On average, the S&P returns 10% a year. So this shows how volatile a company can be, especially these speculative stocks that he had invested in. I'm glad he realized that this is not normal investing, because yes, he had doubled his money, and that's perfect. I would have actually gotten out at 100% gain, to be honest, especially in such a speculative stock. But this can also turn sideways. So you can invest, let's say, $10,000, and you could lose 50%, leaving you with $5,000. It's fun for him and good for him that he actually got somewhat lucky that he got to double his money. But this is just not sustainable. This you feel it coming. Not sustainable, not predictable. So I would highly avoid you to not go into speculative stocks. These their earnings are all over the place. The growth it's very limited. They keep issuing new shares, diluting you as a shareholder. It's just not a good business. But sometimes they double. Sometimes it just happens. And if you're lucky to catch a double, I would, by the way, just get out if it doubles. You've got the bag, secure it, and just go to normal investing after that. But just don't do it. The risk to reward, it's out of proportion. You take huge amounts of risks, and yes, it could double, but is it actually worth the risk you're taking? I would doubt so. So it's funny that he got lucky and doubled it. I would have hoped he would have taken his profit, but he thought maybe it could go up a little bit more. That's, I think, natural behavior for most of the people who are investing. They see something doubled and they're like, yeah, I'm just going to hold it, and then it just tanks again. And this is pretty common in the speculative stocks. You're not going to see Apple just double out of nowhere and then just give everything back the next day. That's something you're not going to see with high quality companies. So good for him, but don't do it. I'm glad he noticed that this is not a sustainable way of investing. So let's get over to the next TikTok.
Here's the top 3 funds I would buy as a beginner investor. Number 1 is the Vanguard FTSE All World Cap. This is a global fund investing into 50 countries from all around the world, and it's like investing into the world's economy with one single investment. It's super cheap and it allows me to be nicely diversified across 3,644 different companies. Its performance over the past 5 years is 68%, and it has an ongoing charge of 0.22%. Now, number 2 is the Vanguard S&P 500. This holds the top 500 companies in the USA, and it continues to be very difficult to beat, and its performance over the past 5 years has returned 102%, and it has an ongoing charge of 0.07%. Number 3 is the Vanguard FTSE All World High Dividend Yield. This fund I'd have a smaller allocation towards, but I do like it because it focuses on high dividend paying businesses. These are much more stable companies that offer dividend payments to its shareholders, which is currently 3.15%, and its 5-year performance is 20.45%, but you do have to add a dividend on top of this. Now let me know what you guys think in the comments below, and I'll catch you guys on the next one.
This is actually a good TikTok. I really like this TikTok that he had made. So we're going to go over the ETFs he had mentioned. So first off, the Vanguard FTSE All World Cap. It's a good ETF, but I do have something to say because his next ETF is the Vanguard S&P 500. So that holds the 500 the best companies in America, the S&P 500. But the Vanguard FTSE All World, it's 60% is allocated to the S&P 500 already. So I've done some digging, and if you want a similar ETF like this one, I would go with the VEU, the Vanguard FTSE All World Index ETF. That's ex-US. I really choked on all my words there. So again, the VEU, Vanguard FTSE All World ex-US ETF. If you would replace this ETF with the one he mentioned first, and then the Vanguard S&P 500, the VUAG, and then the FTSE All World High Dividend Yield, the VHYG, I think you have a better portfolio because, like I said, the first ETF he mentioned, the VWRP, has a high exposure to the S&P 500 already. So replacing it by a ETF that has no exposure to the S&P but other countries around the world, I think this will provide less reliability on the S&P 500 and create some more diversification and resilience over the long term. But all in all, this is a perfect TikTok. I would recommend everybody to do something similar like this. Buy ETFs, buy indexes. Do make sure that there's no overlapping companies, or not too much, because a lot of ETFs hold the same company. So if one holds 5% Apple and the other one holds 2% Apple, let's say 7% Apple exposure you have. If you're comfortable with it, go for it. If you're not, try to find for ETFs that do not have such a high overlap in companies they hold. And the dividend one, good. It's perfect. You get some divvies. You can reinvest these divvies back into these ETFs. In return, you get more divvies, more growth, and you just keep compounding your portfolio. So this is actually a really, really good TikTok. I liked it. I shared it, and I think I even commented on it. I think it's a perfect TikTok, and I think everybody should, who's not not trying to pick their own stocks, they should just go with an ETF like this one. I think you'll do fine. I think you'll be doing more than just fine. And it's, again, you're gonna, I'm gonna say it, sustainable and predictable. And there's not that much risk at all. So this is a very good TikTok, very good options he's giving right here. And I really do like it. So we're going to go over to the last TikTok. I'm already seeing a snippet in the bottom of my screen of what this one is. This one is just ridiculous. It's just false information. And I really want to hear your thoughts on this one. So let's go over it.
You are crazy if you think that the way you are going to get rich is from making the money that you have right now and just investing it in the stock market. That's insane. Why? Because what you are actually doing is you're just letting other people get rich. Who gets really rich? The asset managers who manage your money, the banks that hold your capital. Why do they get rich instead of you? Because what do? They take your money and they do something with it proactively. So they take your money and they take real risk with it. Mm-hmm. And I think unless you take risk with your money, but also with yourself, you're never going to get wealthy. And so you and I could go very viral on the internet every single day if we talked about how to invest your first $10,000 to get to $100,000. Yeah. You could get a lot of views on that, except it's totally pointless. And if what we really want to do is elevate people to real wealth, where they have enough money for all the things that they want in life, it's not done through investing. It is done through earning. That is the only way you make real money. Once you make real money, you can make more of it through investing. But in the beginning, you got to earn. That's it.
I think she is mixing a couple things up, because she makes it sound like that when you invest, that the asset managers and the banks are taking that money and investing it somewhere else. That happens to your savings. So let's say you have a 10,000 balance on your savings, okay? You put that with the bank. The bank takes your savings and they lend it out against let's say a business who wants to expand operations, or somebody who wants to lease or buy a car and needs it financed. The bank is like, okay, you can have this person's 10,000, but I want you to pay 7% interest on the money you've borrowed. So the bank makes 7% on that 10,000. So that could be annually 7%, or monthly. It really depends on where you are in the world. Right here in the Netherlands, it's on an annual basis. So you're paying back and you're paying the interest back. And at the end of the road, the bank has made money. They have made with the 7% interest. The bank then gives my money back with a slight interest, because I deposited it and they could do something with it. So they say, you know what, for saving your money with us, we're going to give you a 1.5% interest. Okay. So they have to pay that 1.5% interest, but they made 7%, or they made money with the 7% interest by lending it out. So the discrepancy there is how they make their money. Okay. But that is with your savings. That is not with your investments. All right. When you invest, you deposit on a broker. With that brokerage account, you can buy shares. So you pay a fee to your broker for buying a share in a company. That's normal. You just pay a fee to get access and to buy a share. If you buy an index like an ETF, you buy a fee for the managing of this ETF. Okay. There is not an asset manager that when you deposit in your broker, that's going to be that 10,000, I'm going to take it and I'm going to do something with it. No, that's not how it works. No, it doesn't at all. It is with your savings. They borrow your savings, they lend it out, they get their interest payments, they give it back to you. They give you a very slight interest payment, and the discrepancy between the interest they have to pay and the interest they get, that's their profit. you have to start investing. Just start investing. It is proven to build long-term wealth. It is proven. The S&P, the Nasdaq, the Dow, just equities, they're the best way to generate wealth. You just contribute monthly and just let compounding do its work. She mentioned a high earning skill. Yes, you need to make money. You can improve your skills and earn more, and then again reinvest more into your portfolio and then boost the speed of compounding. You can do that. But what she's saying is just not true. It's just not true. Your broker is not getting rich. If I buy, let's say I buy 10 shares of Meta, I pay, let's say, $2 on fees for buying those 10 shares. Okay. The next month, I buy again 50 shares of Meta. I again have to pay a $2 fee. So every month I have to pay a small fee. The broker is not getting rich from this. And at the end of the road, you have such a strong portfolio that sometimes contributions is not necessary anymore. Sometimes people have a set portfolio of numerous stocks and I'm just going to leave it be. I'm just going to let compounding do the work. Then there's almost no fees. Some brokers, they charge fees for being on their platform. That sometimes happens. But if you just stop buying and just let it grow, you'll not pay fees. And there's no asset manager that's banking on the fees they're getting for you buying into an ETF or something. They're not banking on it at all. The fees are sometimes as low as 0.1%. You're not going to be making a ton of 0.1%. The majority is going back into your pockets. So this is just false information. They're saying not to invest. Invest. Please invest. Investing is the best way to make wealth. It truly is. Should you maybe dabble into getting a high income? I sound like one of those typical influencers. Do you want a high earning income skill? Blah, blah, blah. If you want that, develop yourself, take courses. There's a lot you can do to develop as a person and develop your work ethics and just gain more knowledge so you can increase your salary via negotiations. You can do that if you want to. You do you. I'm doing the same thing. I try to improve my salary as I go on, But invest along the way. Do it. Do not first aim to make 100,000 a year and then start investing. No. Even if you make 20K a year and you can only invest like $100 a month or less, $50, just invest what you can afford to lose into your brokerage account. Just keep buying some index, and then on the side, while compounding is doing the heavy lifting on the other side, work on your skills and try to negotiate salary so you just keep improving. That is the best way to success. It truly is. Believe me, I'm doing it. It's helping for me. I'm seeing so many people doing this. Trust me, it is the best and most, you're going to hear it again, predictable and sustainable way. The key element to everything here is sustainability and predictability and the risk to reward ratio. Keep everything in check and you'll be just fine. With that said, if you're looking to invest in high quality companies, I do write about high quality companies over on my Substack. It's the first link in the bio. You can click it. You can subscribe for free. I do have a paid plan, but don't feel pressured to take this paid plan. I release a ton of value on the free way. The only thing that's paid is my portfolio updates and very detailed investment cases. The rest I publish is all free. I'm sure you'll gain a lot of knowledge that will truly boost your returns over the long term. That's my promise to you. So with that said, I hope you enjoyed the video. If you did, please leave a like, also leave a comment. And if you're new here, subscribe to the channel. I'm really glad to have you on board here. And I truly do hope to see you in the next video. Cheers.